So on 6/28, we opened the August 21 call for $1.48, and if the call expired, the new at risk would have been 2 cents. We saw that a moment before. This is what the profit and loss chart looked like at the time. With the stock at 21.45, it jumped right above that afterwards, but then it came back down shortly afterwards. But this is what our profit and loss chart looked like. Notice there's our, oh, I'm sorry, let me go back. I'm sorry. There's our $2 at risk now, and the potential maximum return if the stock was trading right at 21 on August expiration would have been about 11.6%. So we turned it into sort of a little collar spread, and then it tails off at the end because we did cap our gain. That's sort of the problem with, well, I don't want to say the problem, but that's one of the issues with income method number one.
One of the caveats.
Yeah, and the caveats, exactly.
Yeah.
Now, as I mentioned, what happened is that we had our initial risk of $1.50. It was 7% on the RPM. We sold the August 21 call for $1.48. That's income method number one. Now, the new at risk if the call expired was 2 cents, but on expiration, the stock had gone up to about 21.40 a couple days before expiration. I didn't want to buy it back. I waited till about Friday, and I was able to close it for about 3 cents. But we still kept $1.45 of that initial premium, right, Kurt?
Right. So you've only got a nickel
Right.
at risk. Essentially, what you've done is you've reduced your cost basis from $21.50 down to $20.05.
That's right.
Am I tracking? Am I right?
That's right.
Okay.
We're going to look at it a slightly different way, but it's very similar. So here we go. What we did here is you notice up at the top, this is the same position. We have our December 20 put at 430, but that $1.48 did reduce the total cost to $20.05, or reduced our stock cost, our effective cost, to $15.75. And here's that profit and loss chart. A different way of looking at it, but Kurt already showed this. What have we done? We've reduced the risk to only $5 total on the position. That's $5 per 100 shares, or 5 cents on the position. Now, this was done, this screenshot, I'm sorry, was done when the stock was trading at $20.64. When this was actually done, the stock was trading right at about $21. And we bought back that 20 call. Now, what are we going to do next? First, we want to review what are some of the common mistakes with income method number one, Kurt. I like to review this because everyone who's researched options might think that, oh, I see what Mike and Kurt are doing. They're buying an in-the-money put, so I can just go ahead and do that now, limit my risk to 5%, and I'll sell the at-the-money call right now and cancel most of that. That's a problem, isn't it?
Yeah, because the fact is you take on an obligation. You've got to understand, and there's principles in the book, you know, that'll show this, the catastrophe report, for example. But if you sell a call at too low a strike, sure, you're going to capture more premium, but you take on an obligation that can turn into a problem. And
you don't want to sell too soon or with too little premium. And then, of course, just some basic general rules of thumb. What we would have done with income method number one is once we open the married put, once we open the RPM, we're going to wait for the stock to move. I opened the stock at $17.20 and bought the put, but I waited for the stock to be trading around $20.50 before looking to apply an income method. We want to wait for the stock to make a move. General rule is a gain of 5 to 8%, or if the stock happens to move up to your put strike price. And in my opinion, what I've seen so far, but it does depend on the stock and it does depend on the movement, but typically the best opportunities occur when the stock's trading right at the put strike price. That's why I entered this call when the stock was trading at around $20, $20.45, because I had the December 20 put. So that's just some free stuff there. It's talked about in the sketch, but this is a little bit further. Some of the things to look for and some of the things not to do with income method number one. Regarding silver wheaton, now what? It continues to go up in price after we close the call. Stock's at around $21. Next Monday after August expiration, it's around it's between $20.80 and about $21.40. But then it starts to move up again. Now, do we want to use income method number one again? Or do we want to use a different income method to bulletproof or potentially earn extra income? Well, this is where we'd consult the blueprint and use the Power Options tools tracking the position in the portfolio to see what opportunities were available. Now,
because you wanted to keep your upside unlimited, right? You didn't want to have to sell calls all the time.
That's right, and I only did it this first time because I could get close to bulletproof. When I first sold that August call, I did have a market order in place, or limit order, I should say, to sell the call at 150. It didn't get filled. I lowered it down a little bit, and then I finally got filled at 148. I really did want to get $1.50 for it, but they weren't budging. So,
Right.
where do we stand right now? Well, we're going to subtract that $1.45 off of our initial stock cost of $17.20. So our new effective cost per share on the stock is $15.75. We have that December 20 put at $4.30. So as we saw, our total invested is $20.05. We still have the 20 put in place, so we're only risking 0.5%. Now, with income method number 4, what we're going to look for is there's a way to lock in profit by adjusting the put to a higher strike. Now, what I was shown on the Power Options tools is I could sell to close my December 20 strike put for $1.10. Now, at this point, this would have reduced the total cost on the position to $18.95, but I don't have a put in place, right? This is just looking at the effective cost per share. Now,
Right, and you're going to want to put in place.
Right, and then I'm going to change my insurance, and I'm going to buy to open a December 24 put at $2.70. Now, this is an income method, Kurt, but if I sell to close my 20 put for $1.10, and I buy to open a higher strike put for $2.70, did I generate a premium for doing this?
Well, no, you didn't. You actually paid to do this because, and Mike, did you do this with just one trade? Was it one spread trade where you close one leg and open another?
Actually, no. If I had done this in my
commission, in other words,
right, if I had done this in my Options Express account, I would have done that. This was actually in my Fidelity account where I did have to enter it as 2 transactions, unfortunately.
Okay. Okay. So you paid 2 small transaction fees, but the point is you received $1.10, and you paid $2.70, so that's a net debit of $1.60.
Right.
But by paying $1.60, you raised your guaranteed payout from $20 a share to $24 a share. So I think it was worth it.
Well,
why don't you walk us through the math of what happens next?
Right. So I had a cost basis here of $21.65 now. We lowered it to $18.95 by selling the original put. Paying $2.70 for the new put gives us a new total cost of $21.65, but now I'm guaranteed an exit of $24. I have a guaranteed profit of $2.35, or about 11% on the position. Now let's take a look at that transaction. See here, I've lowered my cost basis on the stock to $15.75 because of the first income method number 1 position that we kept the premium for. I had the December 20 put for $4.30, and then here I simulated selling that for $1.10, and then buying the 24 put for $2.70, and then down below we see that we have the gain, a guaranteed profit of $2.35 no matter what happens on the downside, still have an unlimited upside, a guaranteed profit of 10.9%, and it can still gain more profit.
So poor baby, you've got to sit on that knowing that you're going to make at least 10.9%, but as it's going up, you may make more. Now, Mike, have you done other income methods since? We don't have to go into detail of it, but have you done other income methods since?
Well, I'll just sum it up real quick, and I have 2 slides that just sum it up real quick here. In September, I was able to use income method number 1 and income method number 2, where we sold the call and then I made an adjustment, and I generated 70 cents of premium by selling a call and then buying it back. So this lowered the effective cost per share that we had on the previous slide here down. Yeah, that reduced our effective cost per share on the stock to $18.25. Now, it did move up. Of course, when we made this adjustment, it would have changed the effective cost per share on the stock to about $18.95. But we lowered that down by 70 cents. And then on September 8th, I was able to use income method number 4 again because the stock was trading at about $26.50.
Oh, boy.
So I closed the December 24 put for $2.20 and bought the December 27 put for $4.